Nice to see your little icons again. My name is Travis Pantine. I'm the director of the Insurance Law Center at the University of Connecticut Law School, and I'm very happy to kick off this third year of the New Ideas in Insurance Law workshop. For those of you who are joining us for the first time, welcome. As background, what we aim to do here is to draw in a diversity of people from a diversity of disciplines to talk about insurance law very broadly construed. Our goal is to create a venue for conversations about insurance law that's interesting not just academics, but or not just to legal academics, but to other kinds of academics like economists, but also to lawyers and students and members of the general public and public servants as well. And in keeping with that, our attendees are a mix of folks, a lot of academics, but also students, regulators, and practicing lawyers. And as you know, the workshop's open to the public. So if you know of someone else who might be interested in this topic, feel free to tell them to join us. And before I hand the mic over to my co-host, Professor Siegelman, to introduce our very exciting speaker for today, a few notes on format. It's going to be the same this semester, but just to remind you, the presentations will generally be between 30 and 45 minutes long, give or take, which will leave between 30 and 15 minutes for questions, give or take. Peter or I will keep a queue for the questions. So if you have a question, either message us or use the little hand raise button in WebEx. The sessions will be recorded and posted to our website after the fact. And the readings this semester, which this is a new thing, are now posted on the New Ideas in Insurance website. And we encourage you to read them ahead of time. Our presenters will probably start with the assumption that folks haven't read the paper, but we may move in the direction of assuming that everyone has. That'll generally make things more efficient. And the workshop will also be held in this same time slot in the spring semester. So if you're putting together your plan for next semester already, please hold this slot in your weekly calendar. And with that, I'll hand it over to Peter.
Great, thank you very much. So it's a real pleasure for me to welcome Liran Einav from Stanford and NVER, as you can see on the screen. It's fair to say, one of the most sophisticated economists doing empirical work on insurance markets. That work draws on his background in industrial organization. For those of you who aren't economists, industrial organization is kind of the field of economics that talks about firm behavior, market equilibrium, strategy, and regulation. And of course, all of those forces are very much at play in the world of insurance markets, but teasing out how they actually work and the subtleties of how they shape equilibria is really the kind of thing that calls for the skills and depth of knowledge and insights that he has to offer. He's the author of two recent books with his co-author Amy Finkelstein. One is Risky Business, which is kind of the background for the talk he's going to be giving today, about how selection shapes insurance markets. And then the other one is We've Got You Covered, in which he and Amy Finkelstein set out to do nothing less than solve America's health insurance crisis and problem. But that's only a tiny fraction of what he's done. I just looked on his CV. I think he has 33 papers just joint with Amy Finkelstein on insurance, plus vast terrains of other stuff. It's really a pleasure. I've admired him for a long time, and it's a huge pleasure and honor for me to welcome him here. So Liran, the floor is yours, and text me, don't text me, but chat me the questions if you have any.
Thanks a lot, Peter. Thanks a lot for having me. Don't believe everything that Peter said. That's like way too generous. But I'm excited to talk about the book. So as Peter said, a lot of my insurance work was done on insurance markets and selection in it. And basically, we started with kind of, you can call it more economic, sophisticated econometric stuff. And at least one of the papers we wrote back in, got published in 2010, got sort of far enough to undergrad level kind of textbooks. And it got us to think that, well, if undergrad can understand it, maybe we can even water it further down and kind of get it to legal scholars. I'm kidding, to get it to kind of general publics. And that's what got us to write the book. And when Peter invited me, I thought that, well, the book came out in January. And it was a kind of a good opportunity to try it out on you guys, in the sense that you're coming from presumably very diverse background and not everybody are into economics. So the goal of the book is to really try to explain to non-economists, whether legal scholars, regular people, other type of disciplines, how economists think about insurance market, and even narrowing it down a little bit, we really try to zoom in on the concept of adverse selection or selection in insurance market, and to really try to kind of take a deep dive into what it is, what it does, and how the market and policy is potentially responding to it. So that's basically what the book is about. As kind of you saw the picture from Peter's, they just came out with it came out in January. It's basically now in paperback, so it's even cheaper. Feel free to order it. You can, just all of you can double our sales, I think. So, and that's it's joined with Amy Finkelstein from MIT and with Ray Fisman at BU. One thing on format, my plan is to just talk through the slides, but talking to the screen is not fun. So I'm more than happy to just take questions, moderated by Peter, presumably through the chat, but as we go. And then my general plan is, unless it's going to be so active that we can just go all the way to 5, but my general plan is to try to stop at around 4:50, however far I get, and then sort of leave 10 minutes for Q&A, and then I can stick around after, kind of, if people want to stick around and ask further questions. So let's get going. So let me start with an example which is not an insurance market, but it's everybody read this example in earlier draft of the book, sort of that it was buried in chapter 3. Thought like, oh, that's like such a great example. So we moved it up to be the beginning. It's really about American Airlines in the early 80s had this idea. The CEO had this really idea, marketed it a lot, about the idea of let's sell an unlimited first class for life type of ticket. I think they had in mind the George Clooney kind of up in the air kind of character, and basically when they first priced it, it was in people see my mouse. So they started it in 81, and they priced it at the time at $250,000. You buy it for life, and you pay $250,000, which is like $750 kind of in today's kind of dollars. And basically you get until you die. Basically you can get on any American flight with a first class ticket. They thought it was a brilliant idea to lock up sort of the really kind of avid kind of passengers. And what they didn't anticipate is like a huge sort of adverse selection, to the point that they got some people who got in and basically started living in first class. Basically they were taking like 10 round trips, New York, London in a month, or doing like around the world like every other month, or some crazy trips. Like just like it was like fun to read all the stories. And what did they do? Well, what normally sort of firms would do, you see that actually the cost of the opportunity cost of these passengers are much higher than the original $750K kind of price tag of the AA pass. And so they moved up. So by 1990, they kept selling it, but now the price was at the time $750, which like in today's dollar was just over $1 million. But what happened then, well, now they got only the really crazy kind of passengers to start buying these new kind of passes. So kind of 3 years later, they moved it up almost to a $2 million kind of, ticket. And then when they got even crazier kind of cases coming up in 1993, by 94, they decided to drop off this entire business and then just not sell this thing anymore. And not only this, they basically realized that even the pool of customers that already bought the old day to commit to whatever they sold them, they started to chase them down to try to look for violations of what they did, to try to kind of get rid of some of them when they could. People was trying to give it to their friends and do other kind of, shenanigans. But it's a nice example to illustrate the idea of selection. Sort of you think you have a good idea because you're setting up the price based on kind of what you think your most loyal customers are doing, not realizing that once you sell something like that, you're really selecting into the craziest passengers, and raising the price to kind of, catch up with the cost is just going to get you even further selection. And that's kind of the theme that we're going to see kind of in different ways kind of throughout kind of this talk. So the book is organized kind of in 3 ways. Like, I'll start telling you a little bit about selection and how do we think about it, and some graphical illustrations. I should say that, again, this is an academic audience for the most part. So I did bring in stuff that, a lot of graphs that are not in the book to give it a slightly more precise kind of flavor. Then the second part of the book is kind of what do businesses do kind of in response to this selection and the different strategies they can take. And then the third part of the book is sort of what the government or public policy is there and how they can kind of accommodate both the good and bad stuff that associated with both selection itself and firms' kind of strategies to deal with this. So let's start with the first. Again, as I said, feel free to kind of bug me with any question that will make me slow down a bit. So why insurance? So let me start. This is an audience, I don't need to kind of motivate it too much, but insurance is important. Sort of, so like it's a real name, Hollywood. So like, she was like a graduate student at the time. She had like a Vox kind of article, basically the way to say why insurance is useful, like every day without an emergency is a relief. And the idea is that, without insurance, basically every day you're just waking up worrying that something really bad will happen. With insurance, maybe you get a lot of peace of mind in general. There are tons of insurance types. I don't need to tell you, like, starting from property and casualty, homeowner and auto insurance, to health, dental, vision, life insurance, long-term care insurance, annuities. Then you have like something which is more regulated, like flood insurance, earthquake insurance. And then, pet insurance I'll mention a little bit. And then you have all this bizarre insurance stuff, like from like phone insurance and boat insurance and body part insurance. If you're a soccer player or an NBA player, you're going to insure your kind of, arms and legs. And you have, multiple birth insurance. If you're kind of doing, you're worried that sort of having a triplet is going to completely kill your financial life. So you're trying to, so you can buy policies for a lot of different stuff. And the idea of selection is, for the most part, is going to come one way or another in almost all of them. It's also a really important kind of market for public policy. And one way to kind of to see this is that if you look at 2020 PAC donations, insurance is by far the biggest sectors in terms of total dollars kind of that are going kind of, to the PAC. So it's just more than defense, more than pharmaceuticals, more than oil and gas. So it's just kind of really kind of big market, no matter how you look at it. So the way to think about selection in this market, let me start with really like a toy model to just get us going. So think of like a two-type kind of insurance setting. We have like a healthy person and a sick person, or a healthy type and a sick type. And the expected expenses from the healthy, they are kind of relatively healthy. They expect to get, say, $60 kind of in expenses in a year. And because the insurance value, they value having the insurance that cover this at 70. So always kind of the value from insurances might be higher than the expected cost you're going to get it because you're risk averse or something like that. The sick type, they are both kind of, are going to, well, they're sick. So they're expecting to have kind of $100 a year. So they're more expensive than the healthy type. But also because they're sick, they value, they value insurance more. So they value insurance at $150. So if you think about what should we do, then the only thing that the firm can do is like set a price. We at that point, we don't know who is healthy and who is sick, so we need to set the same price for everybody. If I set up kind of a price that is above 150, then neither the healthy or the sick type buys, and then I sell nothing, and it doesn't cost me anything, so I make zero profit. If I set the price somewhere between 100 and 150, so that's kind of below 150, that means that sort of the healthy type doesn't buy, the sick type does buy, because one is below 150, which is a willingness to pay. At that point, I make money off the sick types, and the healthy guys are kind of out of the market. I can further reduce the price to go below 100, but still above 70. I'm still not selling to the healthy guys, but at such a low price, I mean, I'm losing money because I'm selling the insurance for less than 100, and it's costing me like 100 for the sick people who are the only one who are buying. And below 70, I get to sell to everybody, but the problem is, if and partly we cooked up the example this way, if I set it at 70, for example, everybody buys, but on average, if they're like 50-50 in the population, then I get 50% $60 cost. That cost me 60, and 50% cost me 100. So on average, my cost is 80 per person. I'm selling it for 70, so I'm losing money. So if you look at this and ask, okay, what's an equilibrium, or in economic speak, what's an equilibrium in this market? Well, sort of the below 100 prices are kind of not profitable. So nobody's going to start a business and sell insurance at this price. So the only equilibrium would be sort of the one that is in the second row here, which is basically we are going to set the price a little bit high, only to attract the C guys, but high enough to make money on the C guys. So that's where we get the adverse selection. The price is going to be a little bit too high than the average cost of the population, and I'm going to only to attract the more costly kind of customers. So that's the basic idea, and you can basically translate this example to a graph. So in this graph, on the y-axis, that's the price I was talking about. On the x-axis, that's the share of the people that are insured. That in this example, either half of them are insured, or nobody, or everybody. And then on this graph, you can draw three different graphs. The blue line, that's the demand curve, which is basically just follows from the little table we had in the previous slide. So when I set it above 150, nobody buys. Once I set it to 150, all the sick guys get insurance because their willingness to pay for this is 150. And then nobody else buys until I drop the price low enough down to 70, which was the willingness to pay for the healthy guys. At that point, everybody else buys it. So that's the demand curve here. What's the marginal cost? Marginal cost is the cost of the last guy that started kind of buying insurance at that price. So for as long as the price was kind of high enough, the marginal cost was like the marginal cost of the sick guys, which was basically 100. And once I started selling to the healthy guys, then every new guy is basically becoming like the healthy guy, which is like the $60 a year type of guy. And then the third line here is going to be the average cost, which is going to be taking kind of at every price and take all the people who bought up to this point with all the people sort of before. So basically the people here, it's only the sick guys. People here are everybody. So it's like 50-50, healthy and sick, so you get 80. And it goes down low. It doesn't matter too much kind of how it goes down. So the key thing to note here that what an equilibrium in economics speak here. Well, I cannot sell insurance when the price is below the average cost, because the average cost is what it costs me to run this business per person. The price is what I'm going to get in revenues from every person. So if the price is below the average cost, I'm losing money. It's like no way that I can survive in such a market. So the price is, and if we have competition, then the price would be where kind of the average cost and is going to cross with the demand curve, which in this case would be what I showed you in the last example, where like only the sick guys kind of buy. So that's the basic kind of idea. If you take this to a slightly more, call it more sophisticated, not much more sophisticated, but slightly more, so we move from the two types case to kind of many type case, you basically get what became like a fairly kind of heavily used picture that we drew in our kind of original paper, where you basically the same concept that I just talked about, sort of demand is not going to be a step function, it's just going to be like a downward sloping curve. You start at a high price, nobody buys. Then as you drop the price, you're getting more and more people kind of to buy insurance all the way up to maybe you sell to everybody in the market. The average cost is going to be downward slope. Let me start with the marginal cost is going to be downward sloping. And the marginal cost is downward sloping precisely because of the idea that the people who are willing to pay the most for insurance are also the people who are sickest, or in other contexts are the highest risk. So that's why sort of the first people that are buying insurance, when you start dropping the price from really high to lower, you're getting first the sicker people and only later the healthier and healthier people. And then that translates to average cost curve, which is basically taking the marginal cost curve and just integrating, on all the people on the left. So it's going, once the marginal cost is declining, the average cost is going to be also declining, but kind of not as steep. And what equilibrium would be here is going to be just like in the simpler case before, when demand and average cost are going to intersect. What happens here? Well, at that point, if I price demand at what we call price equilibrium, that's basically where average cost and price are the same. At that point, I'm breaking even. So if we have competition in the market, then sort of, we can get everybody to beat each other down, like insurance company to beat each other down to kind of to the point that they cannot lose money and make money or lose money, so they make zero profit, and then we get this equilibrium. What is this shaded triangle or trapezoid? This is basically this is like one way to quantify the welfare cost of adverse selection. So this is selection because people that the more kind of risky people are buying first. And this is the share of or these guys between the Q equilibrium and the Q max. These are the people that we would have liked them to get insurance. In this type of example, everybody likes insurance. Everybody's value from insurance is higher than the marginal cost from insurance. So we would have liked, if I could kind of assign insurance, I want to give everybody insurance. They all prefer to buy it and value it more than the cost. But because of this selection, equilibrium is over here, so all these guys on the right are not getting insurance, and the area of this triangle is one way to monetize the overall welfare cost of selection. And we can talk about how can we deal with this and what can we do to kind of avoid selection, or kind of to make sure that we don't lose all this kind of potential welfare that's on the table. Okay?
Liran, can I just jump in with a quick
Yeah.
comment about people who are graph averse, which is that the really amazing insight that I got when I first read your work was there's just a very simple point that is very special about insurance, which is when you buy insurance, you're not just demanding it, you're also causing the cost to change. Unlike when you buy a candy bar, you're just buying a candy bar. But when you're buying insurance, you're contributing to the pool of risks that are being insured. So that's part of why the marginal cost slows down. When the new people come in, they change everybody else, or they change the cost of the.
Totally. For people who might have some, your economics background is either zero or like Econ 101 type of thing, then your first thing you learn in economics is like demand and supply curves, and you basically have demand is like what consumers are willing to pay, and the supply curve is coming from, it's kind of a cost curve or marginal cost curve, but it's coming from engineering. If like, if I'm a farmer, like sort of how much people are willing to pay for the corn that they're getting in the grocery store. And then the cost curve or the supply curve is coming from how much it costs to the farmer from producing or from growing this corn. And then you kind of cross them and you basically get some equilibrium. And what Peter said is exactly what's unique about this selection market. It's in insurance, not only in insurance, but insurance credit markets is a similar kind of case, really where your cost is really your demand. It's just the nature of your. So when you go to the grocery store and buy a corn, the supermarket, they don't care what I do with the corn. Do I kind of eat it? Do I kind of throw it? Do I give it to my kids? Do I kind of feed someone with it? It's all the same for them. The minute I left the store, they sold it, they are done. With insurance markets, when I sign a policy and I get an annual auto insurance policy, that's not the end of the deal, because whether it was a good deal for them or a bad deal for them, well, let's see until the end of the year and see what happened. Did I hit like 3 cars in the way, or did I not do anything? And then I had one conversation with like an insurance kind of practitioner, and they talked about the relationship with their customers as what they can do to do it better. And then my half joke to them was like, my only relationship with my insurance companies is that I'm sending them like a check, once a year. So it's hard to actually, manage this relationship when everything is good. When everything is bad, then the relationship is sour too. So anyway, so 100%. So what's unique about selection markets, and insurance is the prime example, is this idea that your cost curve is really driven by your customers. And then, like, just to the final one on the picture, and then I promise I won't do too many pictures or graphs. So I drew it as everybody should get insurance. You can easily make a case that, well, maybe there are like transaction costs associated with insurance. There might be other reasons that I might not need to sell everybody insurance. People talk about moral hazard. I'm going to stay away from moral hazard stories kind of throughout this talk, but that's you might think that, well, people should not get the insurance, and the only reason they become so costly is because once they are insured, they are overusing it, or they are driving less carefully. Or if you think that like a lot of processing cost of dealing with claims or with kind of people, then you can just think of like the cost curve is all moving up. At that point, covering the rightmost people, the people who are willing to pay the least for insurance, is not efficient. So even with perfect kind of, the perfect intervention, we don't want to cover them. But still you get suddenly the trapezoid becomes a triangle. We get the same type of picture where this is people between the equilibrium guys and the efficient guys are people who are kind of getting sort of, we would have liked them to get insurance in some perfect world, but they don't because of selection. And that's the key thing. And the one thing I want people to remember from this a little bit is that, when people teach adverse selection in very simple sort of undergrad level classes, I think the most common kind of example people use is the used car market by George Akerlof. He won the Nobel Prize for that. And he has like a really kind of nice example of like a complete unraveling, that adverse selection causes the market to disappear. In the vast majority of cases, the market doesn't, in insurance market, the market for the most part, sometimes you can come up with example with complete disappearance of market, but in many cases, the market doesn't disappear. But what happens is that we are only selecting the most kind of risky people, So prices is much higher than it should be, and they don't reflect the population risk, but actually the selected kind of pool of people who actually buy insurance. So the market is shrinking and prices are higher, but it's not a complete sort of elimination of the market. Okay, so now let's go back to some stories. So what are examples of selection in the real world? So one famous example is basically young men in the early 80s in West Hollywood. If they applied for health insurance and they sent, nobody would have sold it to them. So what happened there? Well, that's the AIDS epidemic. It mostly, when for people who are old enough to remember, sort of when it hit. It firstly hit kind of the gay community. West Hollywood was like a place where we had kind of really big share of kind of gay people, and they were like by far the biggest to get the hit early on, and the cost of someone with HIV was huge. So insurance company, instead of trying to figure out who is gay and who is not, who might have AIDS and who is not, they just had it. That was a lot of private information they could not kind of detect. So they decided that was a complete unraveling of the market, at least in this local place. They just did not sell policies for several years until sort of they figured out better ways to kind of handle the HIVs and predict risk and stuff like that. Another case, divorce insurance. There was a little bit of a market for that. That's like a real policy that was sold sort of in the marketplace. But the idea there was that if you get like half the people or 1/3 of the couples in the US are getting divorced kind of in the end, unfortunately, and the policy that was sold, the concern is that like the legal cost of divorce is like really high. What do we do? Well, they sold the policy that you pay into sort of this policy about $2,000 a year. And then, as long as you're married, and then if you get divorced, they would cover sort of all the legal expenses associated with the divorce. If you look at what happened, so what the policy covered, well, for the first 4 years, so they're worried about adverse selection. So one thing they did, which like naturally we'll see it later, the first 4 years, kind of, if I know that I'm going to divorce in 3 months and I want to kind of game the system and buy this, they won't sell it to me. But instead of not selling it to me, they basically tell me that like for the first 4 years that you're paying into this policy, you're not getting anything from us. So our kind of, reimbursement only kicks in after year 4. So to avoid people who know that they're going to get divorced and just try to game the system. And then once in year 4, they basically, they have a cap on how much they are paying for your legal expenses that is growing over time as you spend more. But if you think about this, the average kind of cost of divorce in California was around the legal cost was about $15,000 kind of thing. So let's assume that you're a couple that basically had like an average kind of cost of divorce in California. It basically means that sort of you really need to, that's if you didn't divorce, that was a bad deal for you because you just paid into this and you got nothing out of it. Obviously, maybe it's a good deal for your life, but sort of it's a bad deal for you from an insurance perspective. But even if you are divorced, then what does it mean? It means that sort of if you divorced the first 4 years, you got nothing. If you divorced the 5th year, you got something, but it's not enough to cover all your legal expenses. So you're still kind of net kind of negative because your cost is here and you're capped here and you paid already here. And then if you divorced after 8 years, then actually the cost of the divorce, you're getting everything back, but you ended up paying to the insurance company over the years more than actually the cost. So if you just instead of paying the insurance company, you just put your payment at $2,000 a year in a saving account, you could have accumulated enough money to kind of cover this potential cost of divorce. So really, the only way where you're net positive from buying this insurance is if you got divorced between year 5 and 8, which is a very narrow band. So it really makes it like a really crummy coverage. So this is just a way. Why do we get such a crummy coverage? Because you're very worried about sort of that's the way for the insurance company to protect their kind of bottom line. But by nature of protecting the bottom line, they end up selling you something that looks like insurance, but it really doesn't give you that much. Similar case, if you look at pet insurance, suppose you have like a 15-year-old dachshund. What's a typical, and I had like a big fight with my wife, should we get like sort of a pet insurance for my dog or not? I was against, and she was for, and then she got kind of, not really like the dog got sick, and it was I told you thing. But if you look at the type of deals that are out there, they're kind of crazy. So they give you a policy with a max annual payout with $15,000. they ask you to pay annual premium of $7,800. The first 30% of the expenses are kind of deductible, so $4,500 is out of pocket. So the total cost of getting this is basically more than $12,000 if bad stuff happens. And then that means that sort of the most you can save. So you're paying up front like $7,800 for something that at most can save you like, you know, $2,700. So in some sense, again, it's a similar example of it's just really hard to get kind of in many of these markets kind of good policies, not because, you know, just because the market for good policies won't exist because of selection. And again, the last example is like layoff insurance. Again, something that lots of smart entrepreneurs came in and thought, well, we can sell people insurance coverage for kind of getting fired from their jobs. And, you know, in the book, we cover like a bunch of stories of case after case of kind of entrepreneurs coming up with kind of good ideas and then basically realizing that people know much more than they think they know, and they basically get hit with alpha selection, losing money after a year, and basically getting out of business. And then the last example was like a nice paper by David Cutler and Sarah Reber at the QJE from the 90s. It's like the case of Harvard kind of health insurance plan. What they did, they were selling health insurance, and then they had this idea that we can actually sell sort of an extra, you know, cover that will price it at a higher level. And what they saw is that sort of slowly it was all about how much more to price the health cover they offer their employees on top of the regular cover that people were getting. And they first priced it at one level. You know, they saw that the sickest people bought it, so it became very expensive. So they raised the price, and then fewer people bought it, but the more expensive people bought it. And slowly, and after like 5 years, they took it off the market completely. And the way to see this going back to the graphs, what happens here, there's like a kind of the Akerlof type of analog here. So this is the same graph I showed you before. You have a demand curve, you have a marginal cost curve, and an average cost curve, where now I plotted it as sort of where kind of the market unravels completely in equilibrium. There's like no way to sell insurance and make positive or sell it to positive number of people. And what this Harvard analog in this graphical framework does is basically you say, well, I set the price not in equilibrium, but kind of below the equilibrium price, which is here. At that point, I see a year later who bought this kind of coverage, and they say, what's the cost? Well, the cost would be the average cost of this coverage. Then, like what the Harvard benefits guy would do, well, they basically take this coverage, like, okay, so that's instead of like, you know, $1,000 a year, you know, that we priced it, people ended up spending $2,000 a year. So the next year, let's price it at $2,000 a year to match. They're not trying to make money of their employees. They're just trying to break even more or less. And at 2,000, well, now kind of what happens, that's the price. You shrink the market, fewer people are buying it, but that means also that only the most expensive people are buying it. So costs are still higher. And then you have this kind of, you know, rapid sort of unraveling of the market that you go one by one. And after 5 or 6 years, you kind of go back to kind of equilibrium where kind of nobody's getting this kind of thing. And you take this, you know, this type of kind of policy of the market or of the benefit design of Harvard. And one question that comes up, okay, how do people do this? Like, what do they know that kind of the companies or the providers of insurance don't know? And one famous story, that's kind of the nicest kind of information story. That's a story about the Huntington disease. Huntington disease is, some of you might know it, some don't. It's basically, it's a genetic disease that it's if you have it, you're basically going to develop like really sort of, but not as a kid. It only comes in like at your 40s or 50s, but then you deteriorate really fast once you start getting the symptoms, and typically you die at a relatively young age. But the thing is, like when you're 30, you have no idea. So the only way for you to know whether you have it or not is to know that either one of your parents is the carrier of this, and then you need to know whether you got lucky or not in terms of getting this kind of the gene to you. So you can do a test like at your 30 and see whether you have it. Some people prefer not to know. Those who do the test might know whether they're going to develop it or not. The insurance company cannot ask about it. Woody Guthrie, just like the picture here, like he's a famous singer, and he had it. Emily Oster wrote a full paper on this thing, and that was a nice example of basically, people who had kind of 50-50 chance of having Huntington. They bought insurance. Some of them tested, some of them didn't, and you see sort of that people who knew more that they had it or not are more likely to buy insurance or pay more for insurance. And that's kind of a typical private information they might have that the insurance company will never have unless they could kind of price on this genetic kind of test that, in most cases, they're not allowed legally. Another kind of case, which actually surprised me when we started working on this, is the idea of annuities. So annuity markets, for people who don't know, annuity is the idea that, when you say get to 65, you take all your 401k kind of savings. One way to use them is to put them in a saving account and just pick it up. But that one concern there that it's kind of, what if I live to 120? Then I have 55 years left in me. That's great, and nobody can complain about that. But if I saved, like, I don't know, $20,000 in my saving account that's supposed to, including Social Security, is supposed to carry me through kind of 120, at some point, you just outlive your savings. So the risk here is to kind of live too long from a financial perspective. And what annuity kind of products are doing, they're basically allowing you to basically insure against it. How? You're going to pay the annuity company $10,000 today, and then they're going to send you a check of $1,000 kind of every year as long as you're alive. So if you kind of died at 68, then that means they made money on you. But if you live to 120, then that means you pay them $10,000 at 65, and you got kind of $1,000 every year for 55 years. So you kind of got the coverage that you wanted to make sure that you can eat something kind of even when you're very old. So that's the idea. And the reason when we started working on it, we used data from the UK. What was surprising is that when you think about private information, like the Huntington disease is one example. If you think about life insurance, most of the concerns are kind of short-run information, something that I know that I just got diagnosed with cancer. Nobody else knows it. Why don't I buy life insurance so at least my family has something when I die in the next kind of few years? But all of them are something that I just learned, and I'm going to kind of use this as to my advantage in a short-run sense. And annuities is different because this is my information about how long I would live down the road, kind of in the long run. And this is where you'd think that, actuarian and stuff like that would know much better than I about my propensity to live to 80 versus to 100. If you look at data, though, it's kind of remarkable, and you see it in every type of annuity company data. This is by age 65, age 75 by gender and age 85, the mortality rate of people in the population. If you look at people that hold annuities, like cell by cell, they're much less likely to die. So in principle, people who are buying annuities are kind of much, call it healthier, safer, kind of longer lived. So it's really remarkable that people have this information advantage even in this setting. So that's basically a bunch of examples about selection.
Can I just stop you one quick second? Do you have any sense of what it is that the people know about themselves that allows them to outpredict the insurers that I'm going to live to 100 or that I'm going to die at 70 or whatever?
I don't. It was fascinating to me. I mean, there are like some small ones that we can talk about. So one story that people told, like, did I have a grandmother or a grandfather that lived to an old age? That was like one thing that people told us in annuity companies. They don't ask about your grandfathers and sort of.
But they could.
They could, and the other one, I'll say one. The other one that actually Amy wrote a paper about it a long time ago. Is the idea that socioeconomic status is correlated with longevity. So people who are more educated, richer, tend to kind of live longer on average. And not always you want to price on this, but one thing you could price on, at least at the time in the UK, you can price on where you live, on your zip code, and zip code is, it's a good proxy for kind of socioeconomic status. And your zip code because you need to send these people a check. So you have their address. So that's another one. It would be predictive of longevity, not our word is low, but something that they could have done, they haven't. And it's one interesting thing about annuity, and maybe one reason we also see so much kind of selection in it is that unlike, say, life insurance, which is like the mirror image of this, life insurance, they price everything. It's kind of one thing like in life insurance, they are so worried about adverse selection that they're allowed to price on stuff that they get you into kind of 2 days of test before they price your kind of life insurance policy, and maybe that's why we don't see huge element of selection because they price so much in annuity contracts. Maybe they're not as worried about it, maybe mistakenly, so they don't price on anything. So they only price on age and gender, and that's it. So because they don't price on anything, there's like much more room for other stuff to kind of show up as selection. So quickly on what do businesses do about it? So there are basically two types of strategies that I'm going to kind of mention quickly. One is obviously pricing. Like you can price on more stuff versus less stuff to the extent that you can and you want. And the other one is different type of contract design. So pricing goes back to the early century. That's like a picture of the Lloyd Coffee House. If you know Lloyd Insurance, kind of is a famous company. The way it started at the Lloyd Coffee House in the UK. When they were waiting for ships to come back, they were basically providing marine insurance to different ships and sailors, and they wanted to underwrite it, and they needed to know how to do this, and sort of they were waiting for all the gossip in the Lloyd Coffee House to get all the information they can in order to price this type of things. Today, you don't need to do much this. You basically kind of everything is online, and everything is coming from like an application question. And one, again, not super surprising, like, not only when you get an auto insurance policy, not only they ask you about the obvious stuff that are associated with your risk, like the car and how you use the car and how many miles you drive. They also ask about other stuff about you. And then in the last 20 years, they realized this idea, which is not that deep, if you will, is that actually there are other stuff about you that are actually predicting well enough your driving ability or your driving kind of risk that are not really related to driving. But if they ask about them, they can actually price on them. And that can be an empirical, a competitive advantage. And sort of in the late 90s, they started asking people about their credit reports and stuff like that. And despite all this pricing, you still see kind of a pretty big sort of selection. This is a picture that is based on my paper with Alma Cohen. Peter knows her well. This is from data from Israel. You basically sold the same contract to different people in the Israeli population, but the only way the contract varied was kind of whether they are choosing a low deductible, which is the most covered, versus the regular deductible, high deductible, and very high. If you track back sort of the annual claim rate of these different people who bought into different deductible levels, you see a pretty big sort of decline. The people who buy the most coverage were basically claiming 30% kind of out of the policy had some claim over the year. People who bought regular were 24%, and people with the lowest level of cover, with the highest deductible, were only sort of claiming about 14% a year. So just this is despite kind of a fairly granular pricing. So like a lot of leftover kind of in the pricing. And one thing that limits the ability to price stuff is different sorts of fairness. Is the idea that sort of if you price everything, you might get a lot of backlash, either through PR or government policy and stuff like that. So that's something that has come up. Like Amazon got hit by that, when they had some pricing experiment and got huge backlash, so they stopped doing many of this kind of over the years. The other way that sort of companies deal with selection is the idea of contract design. And the basic idea is that, we had this like little story from Sherlock Holmes of like, how do we get to know something? Well, let's get them to tell us. And how do we get them to tell us? We basically, create like a choice model for the customers, and by self-selecting, the customers will reveal themselves. And the most famous, even though it's not a real example, is when Joe Stiglitz kind of won the Nobel Prize in the context of alpha selection. That was the story he gave in his Nobel Prize speech. And the basic idea was like, what's the best place to locate, like, that's before online kind of was the relevant kind of way to sell insurance. But when at the time when you had to go to an office and sign up for on a health insurance policy, what's the best place to locate like an insurance office? Well, the idea was like put it in a 5th floor in a building without an elevator. Why is it? Well, because only the healthy people who are kind of fit enough to actually climb up the stairs can get to sign it up, and then you self-select them into being healthy, and the people who are sick can do this, so you kind of select them out. So that was one way. Like a slightly more serious kind of and realistic part, wait times is one kind of element of contract design. You see it in many insurance, both health, auto, kind of towing insurance, many things like that. But the idea is that sort of, if I know, it's going back to kind of what's my private information, if I know something about my need for insurance or my likely claim in the very short future, I can kind of game the system, get insurance, and then use it. But, if I have a wait time, then we get rid of this type of potential kind of customers. Another thing that you see in health insurance is like the idea of gym memberships. You'd think that sort of, and it came up like Medicare Advantage, like the private Medicare. many of the plans have this kind of, if you sign with us, you get a free gym membership. A very naive way to think about it is to say, well, they really care about your health. That's the way they market it. The actual way, the reason they offer gym membership, because if there are two types of people, people who will never go to the gym and people who are considering going to the gym, they don't really care, like the insurance companies, they don't really care if you go to the gym or not. They just care that sort of, people who value going to the gym are probably kind of healthier and, lower cost kind of in expectation. So by giving them this free gym memberships, where we are selecting into the people who value this kind of benefit kind of more. So that's another kind of example. Suicide exemption clauses, people are worried about, when you buy life insurance, can you, if you're going to kill yourself, before you jump from the window, go get life insurance. At least you get something to your family. Where they try to protect that, they put like all these exemption clauses, and then the idea of locking in clients. Again, the idea of a short-run information will trigger stuff. So if you sell people insurance and lock them into a contract either for a full year or for 5 years or something like that, to the extent that many of the risks are kind of moving over time, that's something that will help you sort of manage your exposure to selection. What's the government?
I just have one more quick one,
Yeah,
which is that you rely heavily on sales people to sell the product, to push it on the people who don't really want it, because those are exactly who you want to buy. It's the people who don't think they need it. And so there's a saying like insurance is sold and not bought. And that's what they're trying to do, is just like have aggressive salespeople come to your house and make you buy it when you would never think about it. If you're eager to buy it, that's exactly who they don't want as a customer.
Totally, and 100%. That's exactly one takeaway from the book. Is like if you're an insurance guy, or everybody who call you up, don't take their call, and then call all the other people. Anyway, it was like there was a separate. I'm going to mention in the last slide about credit market that has a lot of analogies to this selection stuff. But there was once an experiment of credit limit with a credit card. You give people sort of $300 kind of credit limit credit card as an experiment, and then people who max it out, you don't then give them more, and people who use less than the 300, then you raise their credit limit to kind of 600. So it's exactly kind of your point. Then just quickly on, I'm running out of time, so let me just quickly on public policy here. So what's the first thing you can do if you go back to the old insurance kind of literature from the 70s? The first kind of public policy solution here is like just well, let's just mandate, just kind of stop. That's everybody needs to buy. That if you go back to the graphs that I showed you in the beginning, that was basically we get rid of all the self-selection if we force everybody to buy. So at least in many cases, that's kind of one simple solution. The problem, and is like maybe if you're in some countries you can do this. In the US, it wasn't super effective, and I guess we go to the Robin Williams movie. Kind of he was laughing at sort of British kind of cops where basically they couldn't use guns. So when they threaten you to stop, if you don't stop, they're like the only threat is like I'll say stop again. So it's the same thing with mandates. And you saw it in the US, they put in mandate and it's not clear that you look at the AC, Affordable Care Act, and the health insurance exchanges. There was a mandate for everybody to get insurance when they changed the ACA. Still, we had 10% of the population uninsured. So mandates have like a limited ability, at least in the US, unless it comes with like huge fines, which so far kind of it doesn't. But it does achieve something. So what this is a picture from a paper on the Massachusetts health insurance mandate in the early 2000s, and basically this is the set of people who bought insurance before the mandate. Then they announced the mandate, and then once they implemented the mandate, indeed they got suddenly sort of all the or many more of the healthy people to buy in. So mandate had some effectiveness, not perfect. You still kind of you don't get everybody, but you get more of the kind of the less selected people to start buying once you force them to do this. It is one kind of way to do it. One problem with mandate, it's also you need to, sometimes it's obvious you either mandate or you don't, but in many cases you need to decide what to mandate. And like one example is like if you think about auto insurance minimum requirement, if I wanted to mandate everybody to buy auto insurance, I still need to decide what's a minimal sort of auto insurance policy. And if you look across states in the US, the minimum kind of bodily injury, the liability minimum is really different across different states. So you go from like places like Alaska, Maine, or Michigan, where they're kind of, everybody's mandated to buy 100,000 sort of liability auto insurance. I would guess that if I surveyed people, that would be too high. For most people, they don't need so much. Their assets are not so by buying that's just too expensive to ask them to pay for something they don't really need. And then you have the flip side of Florida and New Jersey that basically they have really, or New Jersey is like they have like a tiny mandate. So what does it mean to have a mandate for something that is really kind of doesn't really kind of have teeth at all? So that's kind of one issue with another issue with mandate. We have a separate paper, the other kind of similar to Monday, but not as extreme, is like the idea of risk adjustment and subsidies. I'm going to go quickly. The point I would make is that if you go back to the graphs, this is the equilibrium in the market. I somehow want to expand the market to the efficient level, which is say somewhere here. How can I do it? I can shift around either the cost curve or the demand curve. How do I shift the cost curve? I basically create what you see in many insurance market, a risk adjustment system, which is basically I'm shifting the cost curve down and kind of make it flatter by giving sort of, giving insurance kind of, more money as a transfer for covering the more risky, to at least predictably risky kind of customers. An alternative, I can just give people vouchers and make them kind of be willing to pay more. I give them like $1,000 a year to pay for health insurance. I move up the demand curve, I get to the same point. So both subsidies and risk adjustment are other kind of public policy ways to kind of deal with selection. And we have a paper about trying to say when one is better than the other and so forth. Then let me skip this one, it's too complicated for the last 10 minutes. And then again, one big thing, especially for a legal kind of audience, one thing to think about is kind of the trade-off. Everything I talked about selection is about, information. A lot of information now you can get, through big data and stuff. And then there's basically a public policy and legal question of what can I price as an insurance company? What am I allowed to price? And if you, can I price on genetic information and other settings? And in many health insurance markets, they don't let you price on anything. And that led to, I'm going really fast, but that led to a complete unraveling. And there's a question, if we don't let you to price on anything, then we get more alpha selection. So sometimes alpha selection is not only an information advantage. I might know everything I need about you, but I cannot use it for pricing because of legal restrictions. That creates alpha selection. So there's like some sort of a trade-off between what I'm allowed to price and privacy and equity issues versus sort of, the less I'm allowed to price, the more alpha selection issues kind of come up. And then the final thing is like something to just, pick your kind of curiosity about is like this idea of, once you talk about public policy in this type of market, you see a lot of back and forth type of, type of game. So one story is this idea of Medicare and Medicare Advantage. So what is it? So Medicare is the government federal health insurance to the elderly once you get 65. The traditional Medicare, which was the vast majority elderly until the late 90s, was basically a fee-for-service thing. You go to almost every doctor you want, they do whatever they do to you, and then they send Medicare the bill and they get it covered. And then over time, they started developing this idea of private Medicare, which is like Medicare Advantage in the US, which is the way that, instead of the government paying the bills to the doctors, the government is basically, or you're selecting a Medicare Advantage. Medicare Advantage plans look like your kind of, your regular commercial plan that many of you are used to, and the way the government compensates the Medicare plan for covering this particular enrollees, and then these insurance companies would basically cover these people and run like a regular insurance company. And then the selection there is like the insurance companies, they want to get only the healthy guys because they get overcompensated from the healthy guys and get undercompensated from the sick guys. So what do they do? So the issue is like what's the right price that Medicare should pay the insurance company from covering this Medicare eligible enrollees? And the the first kind of, they want the healthy guys, these guys kind of, they want to send sort of to Medicare the sicker guys. And the way, what happened back and forth was kind of interesting. Early on, they couldn't price on anything because like no consistent kind of regulated kind of information that allows you to have like the same kind of information about the healthcare of all Medicare enrollees. In the late 90s, at least hospitals started to have a more uniform way to code kind of different diseases. So you could code not only people on age and gender, but you could code people or chronic condition and stuff like that. But you could only do this if they went to the hospital, because the physician practices didn't have the same systems everywhere. So what Medicare did, they started pricing kind of, differently people based on their chronic conditions that were kind of coded up during their hospital stay. What is Medicare Advantage companies do? Well, they started sending everybody way too much to hospitals, because that was the only way for them to get their customers coded up. And that raised kind of the revenues they were making. So then the government went in and sort of developed kind of more sophisticated way to price this stuff. So now they kind of also code people up in regular physician practices. So that eliminated the extra kind of inpatient episodes. So then these guys started to kind of upcode, they got people, if you started signing up with them, they would get you to like quarterly visit and try to come up. They were not making shit up. They were not like illegal, but they were just looking for ways to find issues with you, because every time they found an issue, that's like an extra $1,000 kind of into their kind of revenues next year when you stick with them. And even just last month, I was in a call with Medicare, because they are thinking about new ways to kind of deal with it. So you keep seeing like this back and forth kind of between, there's like no right answers, there's no optimal solution. You keep trying to chase kind of the tail of the same thing, and it's a constant kind of back and forth. This is last example on this. This is that's from a paper by Colleen Curry from Cornell. This is like, for Medicare Part D, that's for kind of different people with different diseases or buying kind of drug coverage. And every point here is a different chronic disease. And on the x-axis, this is like the average treatment cost of people with this disease. On the y-axis, this is how much they're getting, the insurance plans are getting for covering people with this disease. So things that are on the left, these are kind of profitable people. These are people for whom you are getting more money than they're expected to cost to you. And ideally, if the risk adjustment is perfect, everybody should be lining up on the 45-degree line. In practice, some are overpriced, some are underpriced. And what Colleen shows in her paper is that sort of leukemia, multiple sclerosis, HIV, they are kind of way underpriced. So then drug insurance companies are doing a lot of shenanigans to try to, again, legally, by not offering certain kind of drugs available or making them more pricey, try to avoid as much as they can kind of from the more kind of pricey kind of customers. But now price is not in terms of overall cost, but in terms of relative cost to how much you get for them. And then just like the last point I'll say is like, this was all about insurance. This is an insurance seminar. Selection insurance is probably the poster child of selection market, but there are many other cases. One is sort of credit market, one is education market, the third is like employment market. So you have selection type of concern, which is go back to what Peter said in the middle. It's like these are all markets where kind of the transaction doesn't end in the spot market. Sort of, it's not that you price something and you sell it and you're done and you move on to your customer. These are all markets where when you're selling, kind of when you're giving someone a loan, whether it was a good loan or a bad loan, that depends on sort of do they default or not default on the loan. So when you're hiring someone, it doesn't end when you kind of sign the contract. It matters whether this guy is kind of a good employee or a bad employee, a productive employee or not a productive employee. So all these type of markets have very similar type of situation. But in insurance, this is like so front and center that's kind of a common thing. All right, I should stop.
Wow, that was amazing. Thank you very much for covering all that ground at top speed. I do have to unfortunately run to a class soon. Here's my question for you. This is already fabulous and fantastically complicated and rich and interesting. But I want to go back to your car insurance mandates. And it seems to me that there's actually a whole separate sort of wrinkle to that, which is when I'm thinking about how much I should mandate, how much coverage should be mandating. I'm not just mandating like how much risk the customers who buy the insurance should have, but if I'm a judgment-proof individual driving a crappy car and I run into you, I'm also providing some compensation for you. And so there's welfare consequences, not just for the person buying the insurance when we set the minimum, but there's also welfare consequences for the rest of the world who might be in an accident with you. I'm just wondering, have you thought about that? Is that in any of your models? You didn't really touch that here, but is that something that's alive, or that's just out of the picture somehow?
Well, we thought about it. It's not in the model. The simple answer is yes, 100%. Sort of for many, not all insurance, like for annuities, that's probably not a big deal. But for third-party auto insurance, that's for sure. That's kind of the reason that, you know, auto insurance was maybe one of the first insurance is like the externality aspect. It wasn't about selection. It wasn't about any of this. It was all the idea that like if people go crazy in the streets, you know, they're like other people who are exposed, and that's what we are worried about. It's a big deal. It's a reason for mandate. It's a reason for many other kind of regulation. In the context of the models, or at least the model I was trying to kind of, you know, highlight through the graphs and stuff, conceptually at least it's easy, because all you need to say is like, you know, what is the, you know, if you think about all the cost curve that I was plotting, I talked about all the cost curve as like your individual kind of claim cost. But if you want to put like a social cost part, then you just need to move all the cost up by the externality cost. Now, there's an empirical question: how do you measure this, and how you quantify this, and how should it, you know? But in some sense, the willingness to pay still is the same. It doesn't change. You estimate demand, you get the willingness to pay, and the question like, what should we put at the cost? In most of the work that people have done, you only put like the claim cost or the actuarial cost. And in your context, when externalities is a big deal, you just need to kind of move up all the costs kind of up. And you could argue, are the externalities the same, or are people with more accident risk are also more externality risk, which is probably the case in, you know, in health insurance. It comes up when people are not insured, you know, at least in the US system, you know, they're putting a lot of, you know, well, people, you know, go to the hospital treats them, then they kind of send the bill to the government and they need to get reimbursed. So there's like, you know, cost on the system and on the taxpayers that you need to deal with. So just kind of pushing up the cost in some way up.
Fabulous. Okay, I'm really sorry I have to go. Thank you for coming. I'll see you again sometime soon, I hope. Travis, you're in charge.
Yeah, I'm playing around if anyone wants to keep talking. Thanks a lot, Peter.
So
thanks again. Bye.
I'll keep a queue. If anyone wants to ask a question, just raise your hand or send me a message. Maybe we have time for one or two more questions. I second Peter's awe of the speed and volume of knowledge that was just communicated. I'll wait a second to see if any questions come in. Seeing none, I'll ask one. And this may sound like kind of a dumb question coming from someone who's distinctly not an economist, but following up on a question that Peter asked, I wonder how you think about the fairness question when it comes to the question of, you know, actuarially fair pricing. So using your graphical framework, as I understand it, you know, perfectly actuarially fair prices would mean charging each person, each insured the marginal cost for that insured. And so my understanding is that traditionally the phrase price discrimination is used to describe a situation where a monopoly producer is charging different people different prices for the same product.
Correct.
And that can be bad or good for any number of reasons. But, you know, in this context, it might not. Is it price discrimination? ? You know, are actuarially fair prices accurately described as an insurance company charging different people different amounts for the same product, or different people different amounts for different products, meaning like because they are themselves the product in a sense? How do you think about that?
No, perfect. So that's you said everything. I agree with everything. It's sort of the original price discrimination it goes back to the discussion we had in the middle of like demand and supply. Like if you are selling like, you know, a corn to people in the grocery store, it seems unfair that I'm charging different people different things because the cost of this corn is the same for everybody. So I shouldn't be. It kind of sounds unfair. In insurance market, you know, if you are a bad driver, forget about bad driver. You're just driving, you know, 20 miles a day to work, and I'm driving 5 miles a day to work. Why should I not? Why do we price the year versus the mile driven? Like, why don't you pay like 4 times more? And some people would say, and there are like some per mile insurance policies now that started to pop up. But then, so then you say, oh, maybe that's fine. But then what if you're like, you know, a bad driver and I'm a good driver? So is it fair that you get priced higher? You know, I think from the insurance point, they're like, yeah, sure, look at our costs. It's much more costly to cover you than to cover me. Other people would say, I guess, reasonably saying like, well, why should you, not only you, poor guy, like you, not only you were born like a bad driver, on top of it, you need to pay more. I mean, that's like, that sounds unfair. same for like, I don't know, socioeconomic status. Like suppose like, socioeconomic status, is correlated with death. I mean, so should I price more like the poor guys for the life insurance contract? Not only they are bad luck enough to grow poor, but also I need to kind of charge them more, or the sick versus healthy in health insurance. So these are, I mean, these are all, is it behind the veil? Is it for stuff that you are responsible for? Like, these are complicated. That's not economics. So in some sense, we try to stay agnostic to some, we try to stay agnostic in terms of what the right answer. So we kind of give you the framework to think about it. But if you want to, the way I talked a little bit very quickly, obviously, in the graphs about the optimal thing and what's the right welfare. But if you want to apply different welfare metric to different people, you could, and you just need to integrate stuff up in a non-equal way. So I was just adding up dollars, but you can say, well, these guys are more important for me than other guys, and vice versa. So that's kind of the philosophical or ethical or legal kind of perspective. It seems like we have no comparative advantage in kind of saying what's right and what's wrong. But that's I guess that's the way I would think about it. We stay agnostic. But not because we don't care, just because we don't think we have the tools to actually get it. You see it all the time, like in Europe when they introduced the GDPR. I mean, that was like all the discussion was like, is that fair or not? And and it just like, I'm not sure as economists we have any good answer.
Well, great, thank you. Any other questions? If not, then we will thank Liran profusely for a brilliant talk and a great kickoff for this semester. I promised Peter in the chat that I would be very effusive in my gratitude, and I am, and so thank you for joining us. I think this is great, and it's I can say very easily that this is a recording that I'm going to share with my students and mandate that they watch in the future. So thank you.
You need to give them big penalties if they don't. Thanks a lot for having me. It was fun.
Thank you. Have a good one.
Thank you very much.